What is information asymmetry? In economics, information asymmetry occurs when one party to a transaction knows something relevant that the other party does not, and cannot perfectly verify. When buyers and sellers, employers and workers, or borrowers and lenders hold different private information, prices and contracts stop reflecting the whole truth, and markets can misallocate resources or even break down. A quick history. The modern study begins with George Akerlof's 1970 paper, The Market for Lemons, which showed how hidden quality can unravel a used car market. Michael Spence, 1973, explained how better-informed parties can signal their type, e.g. using education to signal productivity, and Joseph Stiglitz, 1975, showed how less informed parties can screen using contract menus, e.g. insurance with deductibles. Together, these ideas, honored with the 2001 Nobel Prize, form the backbone of information economics and the broader principal-agent framework. Two core problems keep showing up. 1. Adverse selection, hidden information before contracting. When sellers, or applicants or borrowers, know more than buyers, prices based on average quality attract too many lemons and drive out peaches. Suppose half the used cars are worth €10,000 to buyers and half €5,000, but buyers can't tell which is which. If they offer €7,500, the average, high-quality owners won't sell, the pool worsens, buyers lower the price further, and the market can thin or collapse. Similar logic explains why health insurers worry that generous coverage attracts sicker customers, and why credit markets may ration loans rather than simply raise interest rates. 2. Moral hazard, hidden action after contracting. Once insured, drivers may take less care. Once financed, entrepreneurs might choose riskier projects. Because effort and risk choices are partly unobservable, contracts must align incentives indirectly, through deductibles, co-payments, collateral, performance pay, or monitoring. How do real markets cope? Signaling, informed party moves first. An education credential can be a credible signal if it's less costly for high-productivity workers to obtain. The single crossing property. Warranties, return policies, and brand reputation signal quality. Firms that expect repeat business invest in signals that are expensive to mimic for low-quality rivals. In finance, insiders committing to skin in the game, holding equity not just debt, signal confidence. Screening, uninformed party designs choices. Insurers offer a menu, low premium, high deductible, versus high premium, low deductible, so low-risk customers self-select into high deductibles. Mobile plans with different data caps or airline fares with refundability restrictions are classic screens. Different types pick different options, revealing information through choice. Disclosure and certification, mandated nutrition labels, financial reporting, emissions testing, safety inspections, and third-party ratings. Moody's, TUV, Fair Trade, LEAD, convert private info into verifiable public info. A famous theoretical result, the unraveling logic, says that if truthful disclosure is costless and verifiable, all high-quality sellers reveal, forcing others to follow, though in practice, disclosure frictions and consumer inattention limit full unraveling. Reputation and platforms. Online marketplaces, eBay, Airbnb, Uber, embed rating systems, deposits, and guarantees to reduce asymmetries. Reputation is a stock that depreciates when you cheat, so it disciplines behavior even when monitoring is imperfect. Design lessons and pitfalls. Tie payoffs to observables that track the objective. Pay for performance should reward outcomes hard to game and within the agent's control. Otherwise, you invite multitasking distortions, e.g., teaching to the test. Use carrots plus sticks. Deductibles limit overuse, moral hazard, while risk adjustment and guaranteed issue mitigate adverse selection in insurance. In lending, collateral plus covenant monitoring reduces risky effort. Beware selection on observables versus unobservables, pricing by observable traits, age, Location is efficient if it tracks risk. Pricing by protected traits can be illegal and raises equity concerns. Regulators face a trade-off between efficiency, fairness, and privacy. Mind dynamic incentives. Short-term bonuses can encourage hidden risk-taking that only shows up later. Clawbacks and vesting align horizons. Examples beyond the textbook: venture capitalists stage financing to observe milestones, screening monitoring. Used car dealers offer certified pre-owned programs, signal plus third-party verification. Hospitals use checklists and audits to reduce hidden action variation. Carbon offsets require verification registries to curb information gaps about true abatement. A curiosity: in some markets, more information can paradoxically shrink trade. The no-trade theorem shows that if everyone is fully rational and common knowledge prevails, private signals can make parties doubt gains from trade. Reality is messier, but it's a reminder that what matters is not just how much information exists, but who has it and how credible it is. Bottom line, information asymmetry is about who knows what, when, and how credibly. Good institutions, signals, screens, disclosures, reputations, and smart regulation narrow the gap so that prices and contracts again reflect real value. Above, I've left more videos to keep learning law. Remember to leave us a like and subscribe.